Hi, Sally. Hi, Steve. Thank you for joining me today. As you can see, I put together a presentation to talk a little bit about hedge risk today. Hedge risk are basically alternatives that you can use for protection against adverse events when dealing with your stock or your portfolio. The three types of alternatives that we're going to discuss today are the protective put, a cover call, and an equity swap. Each of these alternatives have their benefits and they have their downfalls. I will discuss some of them today with you. I will also give you an example of how to maximize the use of each of these alternatives. A protective put. A protective put is basically a long position or long put insurance option. These options are purchased on your stock and it sets a portfolio floor for the value of how much your portfolio is worth. The premium that's gonna be charged for each of these protective puts will be a non-refundable fee. If your portfolio does increase in value, you will still be responsible for paying that premium. Even if your stock decides to depreciate, you will still be responsible for paying that premium cost. The premium cost is basically going to be the cost to be able to purchase the put and put the put in place. It also protects the index value against temporary volatility. If your stock was to increase or decrease, again, that protection is put in place to stop you from having total loss, and also it stops you from having total gain. But I guess it's a balance between protecting the volatility within the market. No matter what, you'll be guaranteed the portfolio value minus any optional premium cost that you pay towards implementing the put. Moving forward, we'll talk a little bit about some of the advantages and disadvantages of the protective put. Advantages I have listed first, and the first one is it allows you to participate in potential growth. Some cases you may see your Cornelia stock, it suffers to grow significantly over a stagnant period of time, or a particular period of time you see stagnancy. The protective put allows you to participate in potential growth based off of the market index volatility. The put option is also relatively inexpensive, so it's a rather cheap way to help add another sense of insurance to your portfolio stock. Excuse me. Some of the disadvantages of the put option cost is deducted from the profit regardless of the outcome of your market. If you have an increase in your value, then you will still be responsible, as I stated before, to pay for the premium costs. And if you did lose or your market did depreciate, you will have like a cushion or a buffer zone, which is considered the put. You will be credited back, and also you would still be viable for the face value of your portfolio fund. There's also an expiration on each of the puts. So whenever it does expire, you would have to just re-up or repurchase a new put option. Each time there's an additional charge, so that could get kind of expensive. So you definitely want to pay attention when you do decide to purchase these puts, and not just be purchasing them consistently because it eats away at your profit. The next alternative that we're going to discuss is the cover call. The cover call is it's kind of like the same thing as buying and selling a call option at the same time. The goal of investors that do imply this alternative is to basically generate an income through the premium that is associated with the purchase and the sale of a call option. The cover call also has an alias name, which they go by the naked option. This option is in correlation to the unlimited loss potential. It's pretty much bottomless or endless loss potential, but it does also negate the fact that you have a stagnant portfolio and you want to capitalize by generating income. The purchase or the simultaneous purchase of the buy and selling of a call option would help you accomplish that particular investment option. Also, the cover call is best for low volatility. Like I said before, it's normally whenever your portfolio is kind of sitting still, it's not really moving, but this is a way to generate an income or short-term income throughout the process of a stagnant market. The advantages and disadvantages. Advantages: the seller receives the premium immediately after they sell the call. If the stock price appreciates past the value, the call may be voided, which is there's a ceiling, and if your value exceeds that ceiling, you may be subject to only claim up to that ceiling due to the call that you purchased. There's also premiums that may offset or decrease in value. The premiums offset a decrease in value because no matter what, you're still going to pay that premium. So even if you decrease or the value of the stock decreases, that premium payment will be charged first or used first to mitigate the decrease in value before you begin to pay any excess or actually lose any funds. Some of the disadvantages. There's excessive stock rise will be capped, which I talked about before as an advantage. Is actually a disadvantage. For example, if the stock was to increase, let's say by $100, but you may be capped at a $75 increase due to the call that you purchased. It's just a way to kind of keep those checks and balances in place. Another disadvantage is that the seller must buy back any of the call options that they have before they can sell the stock and collect any premiums that they make from the stock. Keep in mind, the main advantage to this particular call is to be able to generate a income based off of the premium. Whenever your market isn't moving often, you can use this call option to be able to make a purchase, simultaneously sell that same purchase that you make, but sell it at the premium price, and then you can collect the profits from there. An example that you could use is you can use this to make a quick profit, like I keep saying for the previous two slides. You sell the cover call at the strike price. Once you sell at that strike price, you're also going to get the profit from the difference that the original cost was to the stock or the strike price, excuse me. You're also going to get a premium price, which is per share on top of the call. And also the purchase of a cover call will allow you, for this particular stock, it's $1.80 premium price per share. So if you do the math, you do the multiplication for each share that you have, you multiply that by $1.80, and that's going to be your premium price per share. The last and final alternative that we're going to discuss is the equity swap. This one's used to exchange funds of future cash value, or cash flow, should I say. This also allows for diversification without having to actually sell the stock that you have. I did notice that Mr. and Mrs. Smith both had a strong will to keep and possess the stock that they have from Cornelius. I definitely recommend the equity swap because this allows them to kind of take a short-term break from the stagnancy in the Cornelius stock and then venture out to kind of test the market and swap those equities with another company to be able to benefit for 6 months to a year before switching back. This swap usually happens between major finance companies, which is another thing I want to state. And then there's also two streams of payment, and it's based on what we call legs in the industry. You can either have a fixed rate or you can also have the equity security index. Advantages and disadvantages. One of the major advantages is that there is no transaction cost, so there's no trading fees associated or minimum trading fees associated with this. There's also potential for tax benefits because there's shelters in place, tax shelters, formally speaking, in place to help mitigate the cost of taxes or taxation. You also have the opportunity to invest in exotic securities that you otherwise would not normally have the opportunity to invest in. And also you can avoid the negative short-term returns due to a stagnant market that you're currently investing in. Two disadvantages associated with this particular alternative is there's a high volatility that's normally associated with the net payments. And also, now that you participate in this particular option, you will be exposed to the equity market risk that you were not exposed to before. An example of ways that you can use this to help mitigate your risk. I would suggest using it to generate higher than average returns during a stagnant phase. I know I've mentioned that word multiple times, but again, this PowerPoint presentation is to help us to be able to negate any other risk or any stagnancies within our portfolio. Hence the reason why I keep referencing back to that word. It also lends diversification needed without selling your Cornelius stock. I know that is something that was near and dear to you, and you do not want to sell the stock, but the equity swap would be a great option for you to be able to test the market in other portfolios while also obtaining or holding on to your equities for Cornelius. And also, I would say you can collect on the index fund that mirrors the market index. Summarizing some of the key points that we went over and some of the things that I hope you were able to get from the video. Hopefully you have a better understanding of each of the alternatives that we discussed and how each of them work. Again, there's a lot more detail that can be put into place, but this was a brief overview of the three and just to kind of give you information about them. We've also discussed the advantages and disadvantages of each. This was a little bit of information. There's a lot more we can discuss whenever we meet, but it kind of gives you something to kind of judge or something to compare against, just kind of weighing your options and what you're comfortable with. And also, I hope that you guys were able to get some of the examples of how to utilize each strategy. If there's anything you have questions with, any concerns, anything that does not make sense or that I did not explain correctly, please don't hesitate and give me a call, text message, email, anyway. I'm always available and I love working with you guys. Thank you for joining me. Hopefully you learned something from this and you have a great day.